A bear butterfly spread is a neutral to bearish option strategy constructed using 3 options with the same expiration date, but 3 different strike prices. You would typically 1. Buy 1 lower strike put option, 2. Sell 2 middle strike put options, 3. Buy 1 higher strike put option. The middle strike price is equidistant from the lower and higher strike prices. This strategy aims to profit from a limited downward movement in the underlying asset's price around the middle strike price at expiration. The maximum profit is achieved if the price closes exactly at the middle strike price. Now, let's consider a bearish movement. If the price moves significantly below the lower strike price at expiration, all the put options will be in the money. The profit in this scenario will be limited due to the offsetting long and short positions. Calculating the maximum profit and break-even points. Let's denote the lower strike price as K1, the middle strike price as K2, and the higher strike price as K3. Let the premium paid for the lower strike put be P1, the premium received for each of the middle strike puts be P2, and the premium paid for the higher strike put be P3. Initial cost, net debit. Cost, P1 T2, P2 plus P3. This will be a debit since you are buying more options than selling in a typical setup aiming for profit at the middle strike. Maximum profit at K2 at expiration. K2, A1, on cost. Upper break-even point. K3, maximum profit. K3, K2, K1, cost. Lower break-even point. K1 plus, maximum profit. K1 plus, K2, K1, cost. Minimum daily profit in a bearish movement. This is where it gets tricky. Defining a minimum daily profit in a bearish movement using this strategy is not straightforward because limited downside profit. The profit potential of a bear butterfly spread is capped. If the market moves significantly bearishly below the lower strike, your profit will be limited to the difference between the lower and middle strike prices, minus the initial cost. It won't keep increasing indefinitely as the market falls. Time decay, theta. Options lose value as they approach their expiration date. This time decay works against you if the price doesn't move favorably within your time frame. Volatility, vega. Changes in implied volatility can impact the value of your options. Generally, decreasing volatility after you've established the spread can hurt its value. Delta. The delta of the overall position will change as the underlying price moves. In a bearish scenario, your initial delta might be slightly negative, but it will become more negative as the price falls towards the lower strike. To determine a minimum daily profit in a bearish movement, we need to consider a specific scenario. Let's assume the market moves significantly below your lower strike price, K1, before expiration. In this case, all your put options are in the money. The long put at K1 gains value. The 2 short puts at K2 also gain value, but since they are short, this creates a loss. The long put at K3 gains value. At expiration, if the price is below K1, the profit from the spread will be profit equals K1 market price 2x K2 market price plus K3 market price. Cost profit equals K1 to K2 plus K3 will cost. Since K2 is equidistant from K1 and K3, we have K2, K1, 3 K2, which means K1 to K2 plus K0. Therefore, the maximum profit in a significant bearish move below K1 at expiration is actually maximum profit, bearish scenario, equals K2, K1 cost. This is the same as the maximum profit if the price closes at K2. This highlights that the bear butterfly spread has a defined profit range. Minimum daily profit consideration. It's not practical to calculate a minimum daily profit in the way you might for a stock position. Option prices change dynamically based on several factors. not just the underlying price. However, you could think about it in terms of 1. Scenario planning. Define a specific bearish scenario you are considering, e.g., a 1% drop in the Nasdaq crypto index or Dow Jones within a day. 2. Option Greeks use option pricing models and the delta of your overall position to estimate how much the value of the entire spread might change given that specific price movement. Keep in mind that delta is not constant. 3. Time decay. Factor in the approximate time decay, theta, OA, for that day. Example, illustrative and simplified. Let's say for the Nasdaq crypto index option, K1 90 scouting, K2 100 cert, K3 110. Net cost of the spread equals 2. The maximum profit at K2 to 100 would be 190 Ds, 2 8. If the Nasdaq crypto index price drops significantly to 80 before expiration, the 90 by Y is 10 in the money. The two 100 puts are 20 Y in the money each. Total 40 in the money, but short. The 1 in 10 put is 30 in the money. Ignoring premiums paid, the intrinsic value would be 10 40 plus 30 years. However, we paid a net debit of 2, so the profit would be 2. Using the formula, maximum profit, bearish scenario, x k suntudu, k choose 1, cost equals 100, 90 Cesius, 2, 88. Daily profit estimation. To estimate a daily profit, you would need to 1. Have real-time or end-of-day option prices for each leg of your spread. 2. Calculate the change in the overall value of the spread from one day to the next. This change will be influenced by the change in the underlying price, time decay, and potentially changes in implied volatility. In summary, there isn't a fixed minimum daily profit for a bear butterfly spread in a bearish movement. The profit is capped. To understand potential daily changes, you need to monitor the market and the individual option prices within your spread, considering the Greeks and time decay. Do you have specific strike prices and premiums in mind for your Nasdaq crypto index and Dow Jones options? If so, we could work through a more concrete example to illustrate the potential profit at expiration in different scenarios. Please like, subscribe, share, and comment.